All right, thanks for joining me today to talk about some of our investment strategies, what we're looking for, what's been working for us. This is a turbulent market, and we're always looking for opportunity. We think there's a lot of opportunity in these turbulent markets. So, just want to spend a few minutes today, maybe 15 minutes, going over some of our strategies, how people can get involved, and if you have any questions, feel free to reach out to me after. Would love to discuss further with you. So let me get started with a little bit of our presentation here. All right, so we are Atlis Real Estate Partners. We are founded in 2021. So my partner Greg Katz and I founded Atlis Real Estate Partners in 2021 after about a year-long discussion of creating this win-win partnership. So after college, we both kind of went our separate directions in terms of career. Greg went to law school with my wife, Roxandra, and started a really successful legal career, working his way up to one of the top firms in Philadelphia. I worked on a real estate background, worked with other developers. Then on my own in 2015, wore a lot of hats throughout those years. Built houses, subdivided, property management, was a realtor, so wore a lot. Started raising money for smaller deals, and Greg was really helpful. And then we realized that, if we partner up together, we can use a lot of our skill sets to support each other and grow something bigger. So in 2021, we joined forces, and really our goal is to provide investors the opportunity to invest in like our diversified assets that they wouldn't really have the opportunity to do otherwise. So Greg worked for some big law firms and some big funds, represented some really big funds, 100, 200, $500 million, investment funds that the minimums were $5 million. And so here he was a successful high, W-2 earner, couldn't even really invest in the funds that he was representing. So definitely a gap in the market. We'll talk about that in a second, but we really stick to our core values. So our core values are perpetual growth, pride and ownership, trust, adventure, long-term vision, value add, and no stone unturned. This is a long-term vision for us, long-term plan for us to always learn, grow in our businesses, create really dynamic relationships with our investors, with our vendors, our partners, borrowers, kind of really everybody in our circle. And we also really want to make sure we have some fun along the way. We want to make sure that, we're all really embracing that life is this adventure, this journey that we're all on. And we want to make sure we do it the right way with the right people. So our team has really grown over the last few years. Here's a look at everybody's beautiful smiling faces. We're really, we like partnering with, our teammates in a sense where we want to make sure they all align with our core values. And that's really a great way to do business, and it's a lot more fun to come to work. Our mantra is building better lives through real estate. And so, when thinking about this, we kind of break it up into three different categories. One is consistent returns for our investors so they can make a greater impact. I'm a firm believer that good people making good money can do great things. And so, our investors are good people making good money. And so the more money that we can make them, the more impact they can have. So, a lot of them are very philanthropic, or maybe they're taking their families on bucket list, vacations, or maybe they're buying a beach house, or maybe they're, giving it away. And so there's just a lot of great, circulation of capital that happens when we're able to distribute money back to our investors. And we really love that. We're also preserving housing and building stronger neighborhoods. Everything that we buy is value add. Everything that we buy or lend on is value add. So, we are not, buying or building the high-end apartment complexes that you might see in your cities. What we're doing is we're buying the stuff that has issues, and we're fixing those issues and reinserting those units into, these better units into the marketplace. So most of the buildings we buy have pest control issues, cockroaches, mice, really gross things that people hate to live in. We fix those issues. We make the units nicer. There's a lot of deferred maintenance. We really are really upgrading the units. And we're really keeping that same demographic in those units. We're not tripling rents and things like that. And we're creating a positive impact with every interaction. Building better lives is, yeah, it's important with our team, our investors, but we also think of it as from a vendor standpoint, from a tenant standpoint. So everybody that we want to work with, that we want them to come away from that conversation saying, dang, I really like working with Atlis. Yeah, I want to renew my lease. Yeah, I want to keep working with Atlis. I want to figure out a way to make sure that I can keep giving them my business. I'm an engineer. I want to keep working with them because they see the long-term vision that we are going to some pretty special places. So we talked about this briefly, but we really saw this gap in the market where we could provide this institutional level treatment to investors who would typically not have access to these diversified funds. So, right, these $5 million minimums to these investment funds. Our minimum is $100,000 for our equity fund and $50,000 for our lending fund. So it's much more accessible to people. This way, we can still generate great returns just like the institutional players would. We really emphasize the importance of good, transparent reporting, sending out updates on, trying to send out too many updates almost on our assets, and just really making ourselves really open to talk with our investors if they have any questions. And also diversification. I think it's pretty rare, that you can invest, a couple $100,000, $500,000 and get a group of assets, a group of multifamily buildings or a group of first position loans. A lot of times investors, maybe let's say they have $200,000, that might go to one project, and you're really rolling the dice on that one project instead of having 6 or 7 different projects where one could be a home run, one could be a single. So that diversification really helps. We really have 2 current offerings. One is multifamily, so it's just value add multifamily. We like it because there's this massive demand for workforce housing. We target buildings that we can get between $1,200 and about $1,800 a month in rent for a 1-bedroom unit. That is just, people are building new buildings and they need to charge $2,500 a month. So the people who are making $50,000 a year are left out of all the new supply, and they certainly aren't being able to pay for a mortgage because the mortgage rates have skyrocketed as well. So there's this massive demand for workforce housing. We want to come in and provide really nice looking, modern, updated units for this population. There's a lot of tax efficiencies with bonus depreciation. So we're sending negative K1s to our investors, even though we're also distributing cash flow. So that's a really unique situation with real estate. And our value add strategy can deliver really high returns. So that's, by us adding value, returning money quickly, and cash flowing, can definitely deliver some really great returns. Our lending, we make short-term loans secured by real estate with a low basis to experienced borrowers. So we loan money to fix and flippers. We loan money to people who are fixing a building and renting it out, kind of like we do on a multifamily, and then refinancing us out. So this is a little bit different than our multifamily because we have a fixed interest rate that we're receiving. But that being said, we are secured by real estate with the first position and also personal guarantees from these borrowers. And we're able to really deliver above average, consistent distributions. This is something we distribute monthly. We've been lending since 2020. We haven't missed at least an 8% annualized payment to our investors since 2020 on a monthly basis. And this is a really growing market. Just private lending, private credit, really growing, and it thrives in turbulence. And I think we can all agree this is a pretty turbulent market. By the numbers, our equity funds, we have about 33 active investors, a little over 8 million raised, 143 units in the pipeline portfolio. Our first fund, we raised just under 6 million. We closed that, deployed the money. Our second equity fund is open. We have a $10 million target. I think we're just around 4 million in the first few months. So we're looking forward to raising the rest of that and deploying that in some great assets. Our lending, we've done over 80 loans, over $20 million, 61% flip loan to value. So anytime someone has sold one of the properties that we've lent on, our loan to value has been 61.1%, which is a really great number. It means there's a lot of equity in our loans. And we have 47% repeat borrowers. So what that means to us is that people want to do business with us again and again. And we really want to build that number up to be 60, 70%. because that's really the bread and butter of our business. We don't spend any money on marketing. A lot of our business development is through referrals and repeat business, and we really want to keep it that way. So our investment strategy for our equity fund is fairly straightforward. We want to buy things below market. We want to renovate them. We want to make these effective renovations. Might be, improving common areas, taking care of the pest control, like I talked about, upgrading kitchens, bathrooms, flooring, paint, that kind of stuff. Then we're going to rent out the units at a higher rent. That higher rent allows us to have a higher debt service. So that means we're able to refinance and pull out a loan amount that's going to return, hopefully at least 50% of the equity of that deal within 18 to 24 months. And then we're looking to sell these buildings, at some point. Our funds are typically closed end, so there's a maximum 10 years. We probably look to sell these things 5 to 7 years, but we'll always be, considering the market. Like, for example, right now, not a great time to sell, but when interest rates drop, maybe in a year, maybe 2 years, there could be really a lot of demand for these things, and we could sell them then. A couple of our key considerations when we look to buy a deal: we want to keep our basis well below replacement cost. So if there's a vacant lot next to one of our buildings that we own, we want to make sure that the price per foot in ours is substantially lower than what the price per foot of what they could build next door is. So that's really important. I think you really can't go wrong there. And our yield on cost, we look to have 150 basis points over the current market conditions. So let's say in the market, trades at a 6% cap rate. So that would mean that the NOI would be 6% of the value. So what this means is that if we are stabilized after doing our renovations, we want to be able to have this yield on cost at a 7.5%, because we know that we could sell it for a 6%. So, same thing. If the market is 6.5, we want to make sure our yield on cost is going to be at least an 8. We think multifamily is very recession resistant. We think it's a hedge against inflation. Obviously, there's a lot of talk about inflation currently as well. Supply demand numbers, there's really low supply and there's really high demand, especially in workforce housing. And two of the biggest demographics in the country, millennials and baby boomers, those are, our prime candidates for rentals. And there's the 4 types of returns when you own real estate. And so our investors in our equity fund are actual owners of real estate. So our fund will own an asset 100%, and then individuals will each own a percentage of that fund that owns it 100%. So that means each investor gets all the benefits of owning. So these 4 benefits are cash flow. So if we're charging rent, we're paying all our expenses, we're paying our loan, there's excess cash flow, we distribute that cash flow to our investors. There is principal pay down. So part of our loan payment, part of it is interest, part of it is principal. So essentially our tenants who are paying us rent are paying down our loan every month as well. There's also tax savings from depreciation. So, like I said before, we're submitting negative K1s to our investors, even though we are distributing money, and that's through the power of depreciation. And then there's appreciation, right? So this is the values of real estate are typically going up over, a long period of time. So, the owners of our fund, right, our investors are getting all these benefits. And just a little quick picture for you here to show you some of the type of updates we do. This is a building in Morton. It's just, kind of old, probably from 1995, something like that. And we just came in, new flooring, new kitchen, made the kitchen bigger, brightened it up, better light fixtures. And so, this apartment essentially went from about $850 a month on the left to about $1,250 on the right. Okay, so switching over to lending, which is our other our opportunity in the fund. So what we do is that we're experienced local private lender that specializes in renovation loans with experienced borrowers. So we really want to provide these experienced borrowers with the capital needed to go out and build their business, right? We want to be a small piece of their pie when they're building their real estate empire as well, flipping houses, keeping their rental portfolio as well. So we really want to make life as easy as possible for them, but also, give ourselves plenty of protections along the way. So what's our strategy? So we want to produce these attractive risk-adjusted returns by making short-term value-add loans to experienced builders. So essentially, we want to make sure that our loan has a certain basis, a low basis, percentage of the value. So that's very important when we're doing our underwriting. We want to underwrite quickly and thoroughly to provide quick funding. So a lot of our borrowers are getting great deals, and they might be cash deals that need to close in 2 weeks. There's no way they can go to a traditional bank and close in 2 weeks. It just doesn't happen. However, private credit allows that option. And if we can figure out the terms of the loan quickly, they'll want to work with us. And loan amounts are approximately 65% of value and 85% of cost. So those are those metrics I was just talking about. We want to underwrite, really make sure we understand the market, understand where our value is. So we originate these first position short-term loans to builders and operators to create, improve, and preserve housing. We like to develop these win-win transactions with borrowers for repeat business and growth. We do, figure out ways where if there's certain things a borrower might need that, is a little bit unique, we'll try to work it out with them to make sure that, it covers our basis, but also might help them. So creating that win-win transaction is really important for repeat business. We like to invest with borrowers at a low basis to protect our equity. And we want to generate consistent cash flow. So like I said before, we have not missed a monthly payment to our investors of at least 8% annualized. And that's because we have a pool of great loans that are generating really great returns. And of course, we're building better lives through real estate. So how do we execute on this? Well, we have expertise in our chosen markets and we do thorough underwriting. Really the reason that, this lending business started was because, I had experience flipping houses and renovating, apartment buildings. And, as we started to do loans with investment partners, my expertise in doing this was a big relief, versus someone that had no idea how to renovate a house. Our thinking was, back in 2020 was, if the loan goes bad, Aaron, you can come in and fix it. And so essentially that is still true to this day, except now we have a team around us that can really make sure we can execute if needed. And so we like to work with seasoned builders and operators, people who know what they're doing. We don't really work a lot with first-time people because, it's harder. And we're able to provide a lower rate to our experienced borrowers because, they know what they're doing and we don't have to add in that risk factor. We get first position mortgages and guarantees. So these are personal guarantees. There's a rigorous draw monitoring process. So how this works is that we will loan 100% of the construction, but we will hold it back until it's completed. So borrowers can access that capital by making a draw request. So, let's say they, demo the inside of the house, they do their framing and they do their plumbing. Well, then they might, email us their budget, and say, we completed it. We'll come out there usually within 24 hours and we'll see, yep, it was all completed. We'll take pictures and then we'll, ACH them their money. So they have it within 48 hours. So we want to make sure we can do this quickly, which is another reason people like to use us. But we also want to make sure that the work is actually getting done and it's getting done correctly. And so borrowers also pay us off within a year by either selling the house or refinancing us out with another lender. So our lending criteria, we look at each deal like we would say, hey, would we buy this ourselves? And if we would, then we probably will do the loan as well, because it really just adds more protection. So we look for our loan to value to be 65% or less. Loan to cost, same thing, 85% or less of the total cost. We want to make sure the borrower has a good track record, good credit. I want to make sure they have knowledge of the neighborhood. They're not somebody coming in from, Oklahoma trying to flip a house in Philadelphia. We're making sure we're getting this first position mortgage, looking at the title, and we're getting a personal guarantee from the borrower. So we're really excited about these two opportunities. Since you have these two offerings, we'd love to talk with you more about it. We'd love it if you could join us on this mission of building better lives through real estate together. It's a lot of fun building our team, building our network with investors. So, if there's someone that you think might fit within our team or could be a potential investor, we would really love the introduction and hope to see you out there soon. Thanks for watching.